Bespoke is an Avendus Wealth initiative for engaging with our clients on topics and themes that matter to them the most. We kick off this series with a comprehensive overview of the much-awaited event of this financial year, which is the Union Budget of FY25 presented yesterday. So prior to this budget, we had enough and more speculation on what was about to come, whether it was rural consumption, utilization of the large RBI bounty that was given to the government in the form of dividend, capex, defense, changes to capital gains tax, impact on arbitrage funds, and much more. The government has delivered in all these areas. There are many things to talk about from a macroeconomic standpoint. However, today we want to focus our discussion around the changes made to taxes. Understanding taxation for different products is at the forefront of choosing an investment product for your portfolio, and we are going to take today's opportunity to do just that. I am Twisha Shah. I am part of the Investment Solutions Group at Avendus Wealth. We are joined today by 5 panelists, 4 of whom are our internal senior leadership team at Avendus Wealth. We have Saurabh Rungta, CIO and Managing Director of Avendus Wealth. We have Shravan Srinivasula. He's the head of Investment Solutions Group at Avendus Wealth. We also have Anirudh Gangahar. He's the head of Direct Equity and Equity Strategist at Avendus Wealth. We also have Dhaval Jain, our in-house tax expert. Also joining us today is Mr. Ketan Dalal, who's an industry veteran with over 40 years of expertise in structuring and tax, including M&A. He was previously the joint head of tax and managing partner at PwC India. Since exiting PwC in 2017, he has led Catalyst Advisors, which is a boutique structuring and tax firm. Ketan Bhai, thank you so much for joining us today. The flow of today's webinar will be as follows. Shravan will first lay out the background for this budget and the key changes that are made to taxes that will have a significant impact on your portfolios. This will be followed by Anirudh. He will help us understand which sectors could benefit and which sectors could have a negative impact. I will then request Ketan Bhai to provide us some insights on the key budget proposals. We will then open up for Q&A, post which Saurabh will give us the closing remarks. Since this is a webinar, you will not be able to unmute yourselves to ask questions, but there is a Q&A chat box at the bottom of your screen. Please use that to type out the questions at any point during the conversation, and we will respond to the questions at the end of the session. Without further ado, I hand it over to Shravan to kick off the session.
Thank you, Twisha. Good evening, everyone, for joining in. And what a way to start the series. I think it was an eventful event that we had yesterday, and we have been hoping and thinking about it for more than 5-6 months. And those we have been conversing with, we have been always been pointing out that this budget could be a very differentiated budget, and that didn't disappoint. As Twisha pointed out, the expectations was that the government could be populist, government would do for consumption. There was a stress point on arbitrage funds, long-term capital gains getting increased, and what will they do with RBI bounty? And all these things have been catered to by this government, in the budget speech that Nirmala ji has given for about 85 minutes. I think it was probably one of the shortest, budgets that we have seen from a narration perspective. Now, overall, I think it was a standard budget, more tax changes, and I think we will discuss more upon that and how it impacts the portfolios, and that's exactly why we are here. But just to set the context right, I think in terms of the nominal GDP growth that the government expecting, it has taken 10.5% into consideration, which we think is a very reasonable number, and it can actually be higher than this particular number. And considering this GDP growth, the tax revenue assumption is about 11%, which is also reasonable, and expenditure is about 6.2%. Slightly there might be a miss there, but I think 6.2% is broadly a decent number to assume. The capex number has been put out already in the February statement of accounts at 11.11 lakh crores. That has been maintained. That's a 17% jump from the previous financial year and a 3.4% of GDP. So that is par for the course. What came as a positive surprise, and which we think is a very significant development, is the fiscal deficit number, which was supposed to be at 5.1% compared to the year-end closing last year at 5.4%. it has now come down to 4.9%. So there is a serious effort to consolidate the fiscal deficit, and thanks to the RBI bounty, some part of it has and come into the consolidation front. What is important is they've given a roadmap for next year, where the fiscal deficit would be less than 4.5%, and every year you will see a decrease of fiscal deficit going forward, and the focus is on the debt to GDP ratio, which can go, which can go down going forward. Now, this will do two things. One is it will give us obviously the flexibility in case of bad time periods, to step in. The second thing which will happen is it's a clear indication to the credit rating agencies that the Indian sovereign rating is ripe for being upgraded, and it's only a matter of time that it should be done. So, which is very positive for the country. So that's a macro, I think, benefit that we're getting out of the budget. As a result of it, the net borrowing numbers and now have marginally gone up by about 5% compared to last fiscal year, and I think the market can pretty easily take the supply. The focus has been on employment, MSME, agriculture, energy, all the right places. So overall, we think it's a growth budget, and the budget is in the right direction. Now, if I look into the tax impact, and so I come from investment background. Taxation is not my core strength, but when I break it down into different pieces, and Mr. Dalal will explain in detail, but I see the major things that one should be looking at and how do you simplify things is, they have simplified the tax regime in terms of the holding period. Now it has become 12 months and 24 months, very simply, right? All the listed securities will be 12 months, and unlisted or any other securities will be at 24 months. And there's a separate section that they've provided called the section 50AA, where they have categorized, last year itself, the MLDs and ELDs into that particular section. And this time they've added unlisted bonds to that particular list. Further, the section 50AA has also reclassified the mutual funds. So last year, when you saw the budget, there were three categories of funds which were there: the equity-oriented schemes. Then there was, schemes which had less than 35% of equity, which were classified as specific mutual funds, and there were other mutual funds. And this year, the definition of the specified mutual funds has been changed from less than 35% equity to greater than 65% fixed income, right? So that again creates three buckets: equity-oriented schemes, as it was last year, more than 65% of debt investments, which is classified as specified mutual funds, where there is no long-term capital gains that has been given. Everything that is given is a short-term capital gains. And the third category is other funds like gold fund of funds and international funds, etc., which don't necessarily invest in debt, but the other instrument that they invest into, where the long-term capital gains with a 2-year holding has come into picture. So simplifying things, holding period is now 12 months for listed, and unlisted becomes 24 months. And there's a separate section where LTCG doesn't apply, right? And there is a certain section where 20% of tax applies, which is the 111A section that is to apply. Otherwise, rest all will be marginal tax. So I think there has been a lot of talk about complications of tax. I think it is going towards a common regime. Obviously, we are in the transition, and hence some bit of confusion will always be there, which we will discuss during the course of the webinar. But I think it's again a step in the right direction, where they're trying to simplify and equalizing some of the tax advantages which some of the specific categories have got. One more specific thing which they have done, which is a short-term impact, is the basic custom duty decreasing from 15% to 6%, which is positive in the long term, but it has got a short-term impact on the gold investments that people have done through physical gold or SGBs, kind of trades. So these are the basic components of the taxation changes that have happened. Again, we'll dwell deep as we hear the other panelists. Now, if I go into the illustration, I just want to go into two illustrations, which is the elephant in the room to be discussed. One is there is a change in indexation that has happened. Because of it, there'll be certain section of investment that get benefited, certain section which do not get benefited, right? And I think the argument which a lot of people have in the room is that it's a negative thing that has come about, but it's not actually the case for some of the investments, right? If we just look at this illustration, and we have on the left side plotted return profile, pre-tax returns from 5% to probably 30%. In the old tax regime, where you take indexation benefit, the return profile has been put out. And then in the new regime, where the indexation is not there and the long-term capital gains apply, which is 12.5% plus cess plus surcharge, you will have to pay this much tax, right? So the cutoff is about 2.5%. So any return which is less than 2.5%, you are as a disadvantage, and any return which is greater than 2.5% is an advantage, right? So just to take an example, if you're invested into an opportunity that was giving you 5, 7, 10%, for example, for lack of a better example, real estate, you rather pay more tax compared to what you have paid earlier. But if you're in a high growth assets, like for example, an unlisted share, which is clocking you probably 20%, you have a lesser tax incidence that is going. Clearly, I think the market will realize that, investors will start realizing that, and some of the portfolios will start realigning towards growth assets. Now, even now we hear stories about investments done before 31st of March 23, and the narrative is that the post-tax return is about 7%. No, what is harm in keeping 7%? Probably those kind of discussions will give way for investments moving towards the growth assets, right? So the magic number is 12.5. Any return less than 12.5 is at the disadvantage, the new regime. Any return greater than 12.5% is at an advantage to investors, right? The portfolio calls have to be taken based upon that. The second elephant in the room is the arbitrage funds, and we have been talking about this for quite some time. We have got an industry which has grown from 75,000 crores to 210,000 crores in the last 15 months. There was a requirement to handle this, and I think the government has handled it beautifully in two ways. One is they've increased the short-term capital gains from 15% to 20%. And the second impact is the increase in STT, right? STT on F&O, and arbitrage funds use futures. Their STT goes up from 0.125% to 0.2% for every trade that they take. And this will kick in from 1st of October. So if you look at the illustration here, the expected returns currently, let's say before 23rd of July, is 7.5%. The post-tax return expectation was at 6.15%, right? For individuals, and corporate will also have a similar number with a lower taxation, right? Now, from here to October, because of change in taxation, there is a leakage of 45 basis points. So 6.15% return becomes 5.71% return. And further down in October, when the STT kicks in, because they have to churn the portfolio, there is a increased tax STT leakage that happens. That impact is about 18 basis points on a pre-tax basis. On a post-tax basis, 14 basis points. So compared to the scenario which is yesterday, from 6.15%, you go down to 5.57%. So again, there is a call that needs to be taken whether your money should be there in arbitrage funds or should be moved into other opportunities. And here we think some other opportunities that can come is something like a long short fund, which is in row number 3, where the impact of this is lower from a STT perspective, and taxation has always been higher for them. So hence the the reduction of returns, post-tax returns, post this particular budget has been minimal. So still they're clocking about 6.3% on a post-tax basis. For corporates, that's a different story. For individuals, the corporate bonds doesn't make sense. But for corporates, probably the corporate bond, start to make sense. And since we are in a decreasing interest rate scenario, probably this is one asset class that might take interest. So money is expected to move out of arbitrage funds into some other categories, is what we think is going to happen. Right. So these are the two, I think, illustrations which we just want to show as a precursor to the rest of the discussions, because there has been a lot of talk about arbitrage funds, and since yesterday, a lot of talk about indexation, which gets benefited and which doesn't get benefited. Now, moving back into the asset classes which might get significantly impacted. So again, I will just touch base upon very few of them. To start with, if we can just go to the slide, Trisha. So the equity-oriented schemes, the tax impact is on the basis of the long-term capital gains increasing, the short-term capital gains increasing. Obviously, it's a negative. In terms of real estate, indexation is going away. So that is a negative that this particular asset class has got. However, listed REITs and InvITs have got an advantage because now the long-term capital gains earlier, which was at 36%, will now come down to 12%. Remember the logic of listed securities. Now, listed securities have a taxation of 12 months, and they have categorically mentioned business trust. So hence, this will have a taxation of 12 months. So the period of holding need not be 3 years for long-term capital gains. It will be 12 months. However, the negative is that the long-term capital gains has increased. So hence, there is some leakage from a tax perspective, right? So we go to the next slide, looking at the other asset classes. Gold as an asset class, indexation goes away. That is a bit of a negative. But having said that, the tenor of holding for long-term is no longer 3 years. For physical gold, it's 2 years. and also for fund of funds, which earlier were classified as specific mutual funds. The tagging is gone, which means that these guys can get long-term capital gains at 20% after 2 years, which is a significant advantage. Otherwise, they were unnecessarily getting penalized because they were falling into that specified mutual fund less than 35% equity categorization, which has changed now. Sovereign gold bonds, nothing changes. It remains as it is. The taxation is long-term capital gains if you're holding for greater than 1 year. And normally people hold it for 5 years and to 8 years, depending on the period that they want to hold, which is tax-free in the hands of investors. That still remains. Having said that, there is a basic custom duty that has been decreased from 15% to 6%. There is a 9% duty decrease, but unfortunately, because the current price should also get reflected, there could be a 7.8% drop in the prices that you can see going forward. I think last 2 days, the adjustment was about 3.5%, 4%. Probably you will see another 2-3% adjustment to these prices. So long term, good, because you need to pay lower monies for you to buy these assets. But the inventory that you have currently in the form of physical gold or funds or sovereign gold bond, etc., there is an impact that is coming in. In case of bonds, the significant change is on unlisted, where irrespective of the time period that you hold, it becomes MMR. Listed, still the formula still remains. If you hold for more than 1 year, the taxation is favorable for long-term capital, just that the taxation increased from 10% to 12.5%. Moving on to the mutual funds category, where the funds are in between. It's not debt, it's not equity, it's non-specified non-equity funds. These guys have come into the ambit of 2 years and long-term capital gains, like the gold fund of funds, international funds, etc., which is actually positive for them. Arbitrage funds we discussed. Equity savings have the same logic as arbitrage funds. They have some bit of component in F&O. The futures component will have a higher STT. But overall, I think still as an asset class, it might still be favorable for those looking at hybrid kind of investments. Global assets, there is some clarity now. There has always been confusion whether it is 2 years, 3 years, right? If it is valid, not valid, etc. Now it is very clear that if you hold for more than 2 years, it gets classified as long-term capital gains. And finally, on the alternate equity space, it's a positive outcome. The indexation, which I've just spoken to you about, I think that will help. So if you're chasing returns of 20-25%, the tax go is lower, and hence it's positive for alternate equity, right? So too many things to cover. I think it is a little exhausting for somebody who sees various instruments in a short period of time, but not too difficult. Spending a couple of days time on this, for you, your clients, or for your portfolio would be an helpful exercise. We have released the note, just a few minutes back, which describes all these things. So I think hopefully this will be a ready reckoner for you guys. Not taking much time, I will give it to the other panelists and come back to you in the Q&A. Over to you, Tusha.
Thank you, Shravan, for that insight on the various changes made. I'll hand it over to Anirudh next. He will help us understand the impact on various sectors.
Thank you. I hope I'm audible. Okay. Good afternoon to everybody. Indian equity markets is a market which has been running on narratives for the past good 12 months now, and everything and anything that happens gets to get discounted in a matter of 2 to 3 trading days. This budget was also not an exception to this current trend that we are seeing. Just to put it into perspective, if we look at the closing prices of the Nifty small cap 100 and the mid cap 100 on Friday, and we look at the prices of today's close, we see that the Nifty is flat and the mid small caps are up about 2%. Seems to be the trend that we've seen week on week, and the broad market is kind of flat as well. So in a way, as an equity strategist, you can see the budget was a non-event, given the way the market has reacted. But there are obviously talking points, and I think the talking points are as follows. Well, before I get to the sector, I think the biggest question that people had was what will happen to capital gains, and right from no expectations whatsoever of changing the tax rates to getting a bit of a fear just 2-3 days before the budget. I think the eventual outcome of the hike has been something which most people tend to say that it's okay, it's not too much, and the market will take it in its stride. I think there is a tail end to this attached, and the tail end is that, probably there's another hike coming 12 months or in the next budget or so. And this is just a starting point of that. So I would tend to say that, yes, the capital gains was expected to be moved up. At least that's what our base case was. And it has moved up. Thankfully, it's not been a very, very sharp hike as far as capital gains is concerned. Overall, moving to various sectors and what the measures were. Now, I think the way to analyze it would be that what was given in the interim budget and what has changed since the interim budget. And therefore, because market moves on surprises and expectations, certain expectations were already set in the interim budget. The question is, where did something become better or worse as far as the interim budget is concerned? And while there have been plenty of small, I think, changes in duties, provisions, I would probably stick to just 4 or 5 different sectors which seem to be catching the eye and which probably are more topical in nature. The first one, of course, is real estate. What happens if the indexation benefit is gone? I think a lot have been dwelt upon, and therefore the holding period plus the inflation plus the real estate price would depend upon whether the taxability would be more or not. But I think safe to say from investor sentiment perspective, the investment demand that pertains to real estate and from housing would tend to take a bit of a backseat. So to that extent, you can argue that it's a little bit negative. At the same time, the government has mentioned and urged states to reduce stamp duty. And I think that's again a bit of a positive. And overall, the allocations under various schemes have moved up. So my sense is affordable housing, again, tends to be okay as far as demand is concerned. Near term, though, you can argue that for the developers, that is the real estate stocks, it could be a bit of a deterrent in terms of how quickly they're able to sell off any new launches that they're going to do. So arguably neutral to negative. Actual impact depends upon what happens when your holding period is more than about, let's say, definitely 2 years, because that's where you need to keep the house to get an LTCG. And the second one, which everybody was hoping for, and I think the government has delivered on, is on the consumption side. And I think the government has delivered on it because I think they mentioned that 2/3 of the taxpayers are under the new tax regime. And if you look at the disposable income in the hands of the taxpayers has increased after this budget. The reduction in duties on the precious metals, gold and silver, could revive this particular demand. No taxation on any sin goods, whether it's spirits or tobacco. And there is a thrust on job creation, which I think is a very, very interesting thing. All these things tend to tell you that the money in the hand of the lower end of the society is going to be a bit more going forward. And I think that is precisely what is required at this point of time, because the narrative that we see from the last 12 months has been that, that while urban demand still continues to be and the premium demand still continues to be really good, it is the rural demand or the lower end demand which is actually faltering. And these measures should be able to help, kind of revive, I would say, or just help support the discretionary spending at the lower end. So what can benefit from here? Well, low-end retailers, low-end consumption, even jewelry guys, players who are there, all these people where you can probably have more disposable income to spend towards can be areas or stocks or sectors which can do a bit better going forward. Once again, as I mentioned, these days, the market discounts everything in 2 to 3 trading days. So you can argue that with some of the stocks already are scorching up based on this particular developments. The third one, and I'll continue from the job creation part and the incentive part, which I think can have not an immediate, but a rather long-lasting effect actually, is that moving away from PLI or production-linked incentive, the government has started employment-linked incentive. And I think that's a very, very novel and an interesting idea. This could create a new sector or a new set of companies, which could come in the listed space, which can make this as a business model to try and get the youth into the formal sector and therefore benefit from the SOPs that the government may do. And I think to that extent, I think that's another major sector where it's a very small space at this point of time, but this could be another sector which, like in the past of hydrogen and energy, could come to a bit of a scaling in case this trend over the next 5 years of the government continues. There are a couple of stocks over there already, which already are present, but there could be some more ideas coming through. And then the last 2 names, and probably the biggest 2 things as far as the sectors, banks and NBFCs. Now, for banks and NBFCs as a whole, I think it's a mixed bag. The negative part, of course, is the gold financials, where the cut as far as the import duty is concerned clearly leads to a lower collateral as far as the lending is concerned, and the loan book growth does get hit. So to that extent, the growth in numbers for gold financials will get a bit of a dent. On the other hand, you can say that the allocation and the trust towards housing continue. So therefore, housing finance companies and anybody who's catering to affordable housing will continue to probably benefit. And the third thing, which I think the government has done, is on the MSME side. Three things: new guarantee scheme, new credit assessment model, and help in stress period. I think any sector, whether it's in the IT space or whether it's in the banking and NBFC space, who are lending to MSMEs, tend to get a bit more confidence on the asset quality and therefore a bit more visibility on how much they can lend to. The addressable market would also increase based on whatever the government has done. And finally, the much hyped about hype sectors, infrastructure. No change virtually on the larger scale from interim budget. The number was 11.1 trillion. The number stays at 11.1 trillion. I think to that extent, you can argue that there was a bit of a negative surprise from the market. Market was still expecting something more to happen to all these names. They've not. Doesn't mean that it's a negative thing for them. In fact, today, some of these names itself have rallied back after a bit of a setback. Overall, I think it was known that the capex spend will be good, but it will not be as fast as a rate as it was in post the last budget. It was a very high base. Still, it's about 17%. Overall, the sectors which are likely to benefit, road, railways, shipyards, defense, continues to be where the numbers were back in February itself. So no changes here. Net, I would say that the budget overall for the market has been definitely not negative, despite the increase in the capital gain side, because it was partially accepted, whatever is going to happen. I think the last thing, which I'll probably, before I hand it back to Twisha, is that what happens now? As I mentioned, this is a market of narratives. We were looking at the elections. We were looking at the budget. The question is, what do we look at next? My sense is, if you're looking at a 2-year perspective, you're looking at a potential sovereign upgrade. As far as India is concerned, I think the budget puts us on that path, which is very good, which tends to tell us that the cost of capital of India and the investment attractiveness would increase. Near term, though, I think again hopefully go back to earnings and valuations, where we have always believed that the market is a little bit expensive at this point of time. I'll leave it here, Twisha, and come back for the Q&As.
Thank you, Anirudh. I'll hand this over to Ketan Bhai now. Ketan sir, please take us through the key insights that you think come out of this budget.
Yeah, so thank you, Trisha, and I think Saurav has made my job a little easier by going through quite a lot of detail. What I thought I'd do is, in order to make it easier to comprehend, because some of the proposals are very, very detailed, and I will not go through each slide because that will not make much sense. But what I'll do is, I will just take you through some of the broad aspects. And of course, as I said, Saurav has done a good part of my job. So can we go to the next slide? I thought this is important.
I'm just adding. It was Shravan, my colleague, who had.
Sorry. Sorry, I got the name wrong. Sorry, Shravan. So just thought that I would put this, sort of macro slide, not in the sense in which Shravan and Anirudh took you through, but more on the regulatory kind of macro announcements. So, there are 5 or 6 major announcements made, and I link them later with the tax aspect in some sense. There is a reference of an economic policy framework to be evolved. And, I think the constraints of a coalition government will play out there, because it's not going to be easy. But, when Anirudh said, what do we look forward to? This is one of the things one could look forward to, because when you have a framework, it's easier to function within the framework. There is also a reference for direct tax legislation to be simplified and review within 6 months. With 40 years of experience in direct taxes, whenever the government says it should be simplified or rationalized, I get very, very worried, because what appears to be simplification and rationalization to them may not look the same to a large part of the external world. So this is but this is something, you remember, direct tax code had come many years back, and then it had to be shared because it had a lot of provisions which honestly didn't make sense. There is also a reference to FDI and ODI simplification. There is a reference to a lot of aspects to be decriminalized, simplified, ease of doing business in the Jan Vishwas Bill. Anirudh did refer to stamp duty on property to be reduced, but remember that stamp duty on property is a state subject. And cajoling states to reduce stamp duty is not going to be easy, but at least there is fortunately some move in that direction, because, for example, in Maharashtra, a 5% stamp duty and a 1% registration is on top of a very elevated prices of property is very, very punishing. NCLT benches, there is the reference, that IBC is not working properly, schemes of arrangement, there are delays. The government has not said it in so many words, but that's what it implies. And that's what they are talking about in terms of adding benches and making it simple. Now, many of these are not tax issues, but this is a larger thing. I think it's good to bear in mind. Can we go to the next slide? So now we go to, and again, Saurav did mention a lot of this, but I thought just let's once again revisit the sort of bigger picture on this one. So the classification of capital gains, there have been different periods, 12 months, 24 months, 36 months, and it's very confusing. So now what has happened is the listed securities holding period is proposed to be 12 months and for other is 24 months. And the reason I put it in green is so to speak beneficial and also simple. Saurav again referred to this and I think so did Anirudh. Removal of indexation benefit while computing long-term capital gains. Usually, it will wind up being negative, but we'll go through a couple of examples on property. Usually, it will wind up being negative, but if your gain is very high, then it may not be that negative, i.e., a reduction in rate from 24, including surcharge and cess, because that's what we need to look at, from 24 to 14, on a much larger base without indexation could work out better. The long-term capital gains rate, again, Anirudh and Saurav both referred to it, has gone up to 15% from 12%, including surcharge and cess. I think the view of the government appears to be that this is that people making money in the stock market is like pick up money, and they should pay a larger amount to the government in terms of the bounty, so to speak, that they are making. Short-term capital gain tax rates, yes, that has also increased from 18 to 24 if you add surcharge, 15 to 20 without that, but really 18 to 24. And that 24 looks much higher as compared to, I don't know what impact it will have on, people holding for a longer period, etc. But the 24% looks like a quote-unquote deterrent tax in terms of if there is a marginal 3-4 month gap, people, I think, will hold on to stocks a little more. Next slide, please. Yeah. Okay, so this is for listed securities, as the heading says, but excluding mutual funds. Now, I won't go through every line, and much of it will be repetition, but I'll just do 2 or 3 call-outs here. So the equity shares is an obvious, call-out, but the other is, again, and I think in the context of real estate, Anirudh referred to it, REITs and InvITs are a product which has not taken off as much as one would have expected. So we have, I think, 2 or 3 InvITs, I think Power Grid, IRB, and you have 3 or 4 REITs, you have Mindspace, you have Blackstone, you have 2-3 more. But there have been all sorts of fuzzy aspects on taxation, which is one of the reasons that the product may not have taken off. Now, that period has now been, the long-term period has been now reduced to 12 months. But the long-term gain is, of course, gone up from 10 to 12.5, which effectively is about 14 or 15%, including surcharge. In terms of the other call-out is that the listed bonds and debentures, again, the rate has increased. And equity shares and all we already talked about. MLDs were anyway amended last year, so I'm not going into that. So these are some of the call-outs. Let's go to the next slide. Now, this is a very important one. Not many people would have realized the implication, but let me explain. This is for unlisted securities. So first, let's go to equity shares. Now, some of the people on this webinar, many of the people on this webinar would probably be running, operating companies. They're not just investors. And many of you may have unlisted companies. And if for some reason you are in the process of sale of those companies or you intend to sell them, the capital gain rate for unlisted was 24%, roughly including surcharge, etc. Now it will be 12.5%, which is about 14 or 15%. And that's a significant delta. And even without indexation benefit, that may work better. And I'll tell you why. You see, in a promoter company, unlike in the case of buying listed shares, it is very likely that your base cost of holding will be lower. So take an example. Let's say your cost of holding is, say, 20 crores. And with indexation, it could have been, say, 60 crores. But the sale price could be 500 crores. Now, when you look at a 500 minus 40, 460, and you look at a 12-14% on that, it's 50 crores. Whereas even with indexation, 24% would have been much higher. So the significance of this has not been realized. I may also point out, although it's not written here, that even if you do a business sale, okay, not a company sale, the same beneficial impact will apply. So this is a significant, benefit that, I thought you should know about. The second call out is that the transfer and maturity of bond ventures, which are unlisted, the long term, short term, all becomes irrelevant and slab rate. So I think there is a clear disincentive for holding unlisted products. So these are the two call outs on capital gain taxation insofar as the unlisted part is concerned, which is this slide. Okay, now let's go on to others, and real estate we'll talk about. A lot has been spoken. You would have seen a lot of stuff in the papers. The 12.5% rate, but without indexation, I did a lot of working, and some of this is in the next slide. It may not always be negative. It may be beneficial, or it may not be. In many cases, it will turn out to be somewhat adverse, but not always so. For gold and silver, and at the 36 having come down to 24, and that's why it's in green. So that's a beneficial thing. So to that extent, some of this is beneficial, but it will depend on what you are holding, what you are selling, etc. So I spoke about real estate, and my team worked out that take 2002, if you're holding a property from 2002, only if your property has appreciated 8 times, which in 22 years is not or may not usually happen, but it is not impossible. And I would say 20 to 30% cases it would happen. Then you are better off with the new regime. And if you we took one ad hoc year of 2012, then it is about 3.6 times. If it appreciates more than 3.6 times, it is beneficial. I'll give you an example of this in the next slide. Some numbers. Let's go to the next slide. And some rough numbers I've taken. Let's say cost of acquisition 12 lakhs, 10 lakhs, and I've taken 2011-12, by the way. I didn't take the too many examples. And you are selling it this year. 3 scenarios. 35 lakhs, 50 lakhs, 25. Why 35 lakhs? Because remember, that's the cutoff I wanted to explain. So the top part of the second part, the top part, which talks of capital gain, and it talks about old regime and then new regime. So in the old regime, if you sell for 35, your cost is 10, but your index cost is approximately 20, 19.72. And therefore, the capital gain will be 16 lakhs. And at 20%, it is 3,23,000. And that is the same number that comes at 12.5 without indexation. So that's why I'm saying that there's a cutoff depending on the index for each year. So under the old and new regime, if your property is appreciated by 3.6 times, if you take the year as 2011, then you are neutral under either regime. But scenario 2 is where you make much higher, the sale price is much higher. It's not even, it's 5 times, not 8 times, 6 times, just 5 times. They're taken an add-on. You will see that the tax comes to 5 lakhs under the new regime. Because the higher profit in scenario 2 is such that it more than neutralizes the benefit of the indexation under the old scenario. And under scenario 3, where the appreciation has not been much, There the indexation works out much better, and you will see that number 1 lakh compared to 1,87,000. Now this is a lot of, because it's a busy slide, and the idea is not to sort of go into excruciating detail, but the broad picture. Again, Saurav has talked about this, but going to different types of mutual funds, equity-oriented mutual fund, you will see the red on the screen. 12.5 and 20 is negative because obviously it has gone up from 10 and 15 to 12.5 and 20. And of course, surcharge and cess will be added, but I didn't add surcharge and cess here because it will depend on your slab rate. Now, in terms of debt-oriented and specified mutual funds, which Saurav referred to, plus 65 into debt, again, extremely complex, acquired post 1st April and sold on any date, acquired prior to 1st April, etc. I think the red one is more relevant. If you have acquired, if you have invested in a debt-oriented mutual fund as now defined from in the last 1 year or now, then it will be taxable at slab rate. And therefore, I mean, the punchline at the bottom sort of says debt mutual funds out of the game. I'm not seeing much benefit of debt mutual funds unless one has a very heavy safety mindset, because the tax regime is not in favor of debt mutual funds in most cases now, is at least what I think. Okay. Now, hybrid funds, which is more than 35% but less than 65% equity, the reduction in the period of holding for computing long term from 36 to 24 is beneficial. 12.5, of course, is slightly higher, but overall, I think it will be beneficial for hybrid funds. Okay, the other, again, I think Saurabh and Anirudh both referred to other mutual funds, gold, silver, international fund of funds. Again, a lot of detail, but by and large, if it is acquired after 1st April 23, and let's go by that assumption, because otherwise it will get very complex. You will see from the red lettering that is likely to be negative because of the slab rate applicable as opposed to a concessional rate applicable. So that's a clear negative. So I think the whole spectrum of what is good investment should logically not be driven only primarily by tax, but I suspect that tax will become a very major consideration in making investment decisions, given all this complexity and given the slab rate issue as opposed to a quote-unquote concessional capital gain regime issue. Concessional capital gain regime. Okay. ETFs, okay. Now, ETFs, because they are specified securities and listed, may be better off, okay, as compared to mutual funds, even though their tax rate has increased, but they seem to be better off than mutual funds. I mean, if there are any questions, we can go into it, and I'm sure Saurav can answer that, some of it better in terms of investment opportunity, but overall, it seems better to me compared to mutual funds. That brings me to the last 2 or 3 slides. Now, this is again very important. So again, many of the people in this webinar would be having closely held companies. And, you know, when for the last several years since angel tax has been there, you know, honestly, my blood boils when I think of angel tax because it is one of the most obnoxious and outlier provisions one can imagine. You know, first of all, the term angel tax itself is misleading because it seems to indicate that it applies only to startups, but that is not so. It applies to all private companies. So if any money is put in a private company, can you imagine the need for the company to justify the premium, in the absence of which the so-called excessive premium will be taxed in the hands of the company? I mean, the absurdity of this provision is so obvious that there's no need to explain it further to this audience. But it came because there were one or two outlier cases, complete outlier cases, company which is a shell company, 5 crore equity, no business, 200 crores pumped in as a premium. But you have provisions in the Income Tax Act, General Anti-Avoidance Rule, sham transaction to deal with. You didn't need this absurd provision. the amount of litigation it has caused is very substantial. Can you go back to the slide because it's gone off? Yeah. So that last year, by the way, they extended it even to non-residents. And this year, they have reversed that, fortunately, because I always say that the best way to address a mistake is to accept it and amend it. And they've done that. So now this absurd provision has gone. There are many other absurd outlier provisions, but at least this one is gone. So therefore, for those of you who are having private companies and you make the private company equivalent of, let's say, a QIP, preferential, pre-IPO, etc., you don't need to justify that investment because all of us know that investment valuation or valuations investment are very subjective based on the future. The judgment of the future is very tricky and so on and so forth. So I won't go into the detail, but bottom line, the abolition of this provision, I think is corrected something which should never have been there in the first place. But one can always say that thank God at least it has been done now. Okay. Yeah, buyback tax. Now this is a little peculiar one. So in terms of buyback, and I'll first talk of listed companies. The impression I have from interaction with the capital market regulator, which I have personally interacted on a couple of these issues, is there was a feeling that if a listed company does a buyback and A, B, and C tender their shares and the company pays the buyback tax, but D, E, F, and G have not, indirectly they are bearing it, and therefore should the company bear it? Should it not be borne by the shareholder? Maybe that's a valid point. The problem is the characterization of the buyback consideration. To my mind, a buyback should have been classified as capital gain and not as dividend. But what have they done? They've classified the entire buyback amount as dividend. And then they've said, now look at all these complexities. Then they've said, oh, by the way, if your investment was 10 lakhs and you got 15 lakhs by way of buyback, the 15 lakh will be dividend. But what about the 10 lakhs? Because the shares have gone now because they've been bought back. So the 10 lakhs is considered a capital loss. So, on the one hand, you have a dividend income taxable at a higher rate, which is 36% at the maximum rate, and a capital loss. And if it is long-term or short-term, depending on that, it can be set off against future capital gain. But the point is, the dividend is taxable at a higher rate, and the capital loss is set off against capital gain, which may or may not be there in the future, in the near future. And therefore, you're sort of upfronting the tax and upfronting it at a higher rate. And honestly, the logic of this in terms of characterization is something which I have not been able to wrap my head around, but it is what it is. This no more corporate gifts, when this was a situation many times, and I don't know why they have amended it because there was not really much planning here. Things like a holding company drops down a business into its subsidiary because it may want other investors to come in. But those kind of things, because nobody in his right senses is going to make a gift from a company as such, because it could also have deemed dividend implications in other cases. So I don't know why they've amended, but they have. The last bullet on this slide is important, because the corporate tax rate for foreign companies, I'll come to that explanation in a minute, is sought to be reduced from 40 to 35. So it's effectively from 43 to 37, including surcharge. But this is not for MNC subsidiary. So it is not for Colgate India. It is not for P&G India. It is not for Ichigo India. It is for Colgate USA. P&G USA, if for some reason it is deriving business income in India, to that. It may apply to a Citibank, a Stanchart, because remember, these companies are not Indian companies. They operate as branches because of Banking Regulation Act. It is for those. It is not for the Indian subsidiaries of MNC. So I thought that's important to understand. So it will positively impact infrastructure companies like dredging, etc., because those companies very often have, project offices for limited period, so building roads. So it will have some positive impact on infrastructure. May not be a lot, but to some extent. So that is what I wanted to cover. So with that, thank you, and over to Visha.
Thank you, sir. That was very insightful. We'll now open it up for questions and answers. You have a chat box at the bottom of your screen, requesting everyone to post your questions over there, and I'll take them up as and when they come. We already have a few questions here. I will start addressing these. Ketan sir, I think this one can be answered by you. What is the concept of base year 2001?
So, there has been what had happened, the indexation was originally from 1981. Then they shifted it to 2001 because 1981 looks like in the back of beyond. From 2001 is 100, and today the indexation for 2024 is notified each year based on I think the wholesale price index, if I remember rightly. So it is today 363. Last year it was some 354, something like that. So suppose it's 2001, it is 100. So if you bought a property in 2001 for 10 lakhs, then the indexed cost of that property in my example is 36 lakhs 30,000 because the index is 363. Because that was just an ad hoc year taken, moved from 1981. But I just want to make one point. There's some clarification that the government gave that no, if you buy it before that, the indexation will apply. But there is nothing in the law. So I don't know whether they are going to amend the law. That's what it seems.
Right.
But to your question or the question that was asked, the answer is what I just gave.
Okay. Another question that comes up is on a lot of questions on unlisted equity. Again, Ketan sir, Shravan, please feel free to answer these. Is there any change in taxation in slump sale of unlisted businesses?
Yeah, so as I mentioned, Trisha, so what happens is that in the case of a sale of a business, which is strangely called by the word slump sale in the Income Tax Act, that is something which was earlier taxable. So normally the business would be more than 3 years old. So now in any case, that is 2 years. In most cases, it will be many, many years old anyway. So it would have been long term anyway. But the rate of tax instead of 24 is now 14, including surcharge and cess. Of course, if the company is selling the business, which would normally be a case, in the normal case also the company rate would be 25%. And this was 23. So there was not much delta. But there is a massive delta between a 24 and a 12 or a 24 and a 14, sorry. So yes, there is a change and that's a very positive change.
Right. What about tax impact on private equity fund of funds?
Honestly, that question I have not thought about. But generally in private equity, I'm assuming that the private equity is category 2 AIF. I'm not going into category 3. So 1 and 2 have the same pass-through regime. But let's take 2, which because 80% of the funds are in Cat 2. So in a Cat 2, yes, some Cat 2s do invest in listed equities. But our experience has been that 80 to 90% is in unlisted equity. And if it sells the unlisted equity also as an unlisted share and not in the course of a IPO or an OFS, then the rate of tax is much lower. As I said, it's 12.5-14%, including surcharge and cess. So in that sense, the return on AIFs, at least considering the tax delta, would be better.
Yes, exactly, Ketan bhai. I guess since it's a fund, a private equity fund of fund, especially Cat 2 pass through kind of a taxation. So the underlying tax regime will apply. And there the biggest benefit is the fact that you have been brought on a similar handle of holding period as between listed and unlisted, which is 2 years. And you have been brought on a similar handle of tax rate for LTCG at least, which is 12.5%. So massive benefit for private equity fund of funds.
Correct. I forgot to mention, sir, Saurav, I forgot to mention the time period. You're right, absolutely. But usually it will be anyway more than that. But I think the real benefit, as you said, is in the tax rate. So yes, I think private equity will benefit to that extent for sure.
Sure. Shravan, maybe you can answer this one. What about investments made in debt mutual funds prior to 31st March 2023? I know you've covered it briefly, but if you can just touch upon this again.
Yeah, so I'm assuming that this debt mutual funds are greater than 65% debt and money market funds. So before 31st of March 23, indexation benefit was applying, which is if you hold for more than 3 years, post indexation, you pay 20% tax. Now if you hold for more than 2 years, right, the long-term capital gains applies, and that will be at 12.5%. So indexation is gone. The test of time period has come down from 3 years to 2 years, and you attract 12.5% tax.
We have another question on buyback, and this is in particular for unlisted equity. So for unlisted equity buyback, the change in taxation would be from 1st October 2024. So from today till 1st October 2024, does the old system still apply?
You're asking me, I suppose. So yes,
Yes,
Tusha,
sorry.
it does apply.
Yeah.
The only thing to note is, see, today we are on the 24th of July. And having carried out some buybacks for unlisted companies, I have been shocked at the procedure of the buyback. Even for an unlisted company, you need to open a separate bank account. There is a massive procedure, almost like a listed company. So can it be done? Yes. Is 2 months and 7 days enough? I think it is enough. Is it cutting it fine? Yes, it is cutting it fine. But if you are in a state of readiness with the conceptual decision, so we are actually in the middle of doing that, because in a family settlement where 2 brothers were separating, we did one last year and we are doing one now. But what has happened, we are 30% already into the paperwork. So then I think we are able to finish it, or we will be able to finish it in the next 1 month. But if you're not in a state of readiness, whoever has asked the question, I would just caution, please do not ignore or do not underestimate the paperwork involved in getting this done. It is mind-boggling. You have to upload a lot of things on the MCA portal. MCA portal will keep hanging. I mean, this sounds like a ridiculous sort of issue, but remember, it can completely derail the timeline. So, but if you move very fast, yes.
Saurabh, maybe you can take this one. Where will the investments in mutual funds flow, equity, debt, etc., considering the new tax norms?
So, if you look at it very clearly, there are 3 categories that Shravan had called out. There are clearly 3 categories in mutual funds that have got created from a tax perspective. Equity mutual funds, where you get a similar taxation as the listed equity share, 12 months of holding and 12.5% or 20% as the case may be. Second category is debt mutual funds. And the third category is the residual category, which is neither an equity fund nor a debt fund. So debt funds are going to be at clearly a big disadvantage, especially for people who are already in the 30% plus tax bracket. And our clients are already in that UHNI category. So I guess we all are qualifying for that. So from our perspective, a mutual fund debt loses a lot of interest or loses the sheen that it was enjoying until 1 year back, 1.5 years back, until the tax arbitrage was taken out. So that was the precise reason why CASA deposits were going into debt mutual funds rather than remaining in CASA, especially for the UHNI clients. Equity fund will continue to remain the flavor. Obviously, amongst the UHNI space, our clients that are present on the call, customized version in the format of an AIF or PMS will have equally good footing. So we will always have to decide between which manager is available on which platform and how his strategy is doing. But ceteris paribus, if the strategy is available across all the 3 platforms, it's a no-brainer. People will want to avail that strategy through a mutual fund platform. You will be still the most tax efficient in mutual fund. The third category, which is the residual category, which has gold fund, silver, Bs, and all your international funds, I guess they will again have a big inclination. There will be a big inclination and a big move towards them, because they were unfortunately, with the last year's budget change, they were unfortunately getting treated as the debt fund category, MMR taxation all throughout. Starting 1st April 2025, if you sell them after 2 years of holding, they will be eligible for a LTCG at 12.5%. So any allocation in these kinds of asset classes with more than a 2-year horizon, investment horizon, will start seeing a lot of interest. So equity continues to remain on the top. The residual category will start attracting a lot of flows. Debt will continue to struggle.
Got it. Shravan, this one can be taken by you. What is the potential impact of capital gain change on PMS and AIF managers?
Yeah. So when you look at PMS and AIF, the taxation is similar to that of individual taxation. So long-term was 10%, now it will move to 12.5%. Short term, which was at 15%, will move to 20%. So the tax, assuming the returns are the same, right, compared to the past, the tax incidence for these guys have increased, right? So there will now be a debate, between mutual funds and PMS/AIF. So PMS/AIF should have that return potential, which is far superior to that of mutual funds to overcome the increased tax incidence and be profitable to our investors.
Right.
Sorry, can I just sort of supplement, Shravan?
Yes, please.
So I think just for the benefit of the participants, I would distinguish between the three categories. Mutual fund, Shravan, is what you're saying. AIF we talked about. In PMS, the taxation will be, in the hands of the PMS investor. So it will happen in that form. Whereas at the platform of an AIF, it will be at the AIF level with a pass-through. So it's slightly different. That's what I'm telling you. Okay.
Shravan, I think this one also is more relevant to you. The costs borne by arbitrage funds because of the rise in STT taxation, can these be adjusted in their existing TER?
Yeah, so that can be done, which is done now. But remember that arbitrage funds are treated as equity funds, so the slab is higher. So anyway, they charge a lower expense, right? And assuming that the STT outgo is higher, they can increase their TER, right? Because they have the room to increase it. So keeping profitability intact, they would have to do that, right?
Yeah.
So hence the impact of STT is now taken as investor return loss than the loss for the AMC.
Ketan sir, one more question for you. For unlisted preference shares as well as equity shares, whether the indexation benefit will continue after the 23rd of July 2024? I suppose the answer is no, right?
No. No, there is no indexation benefit concept, as you know.
Got it.
The question is only which is more beneficial. So that, as I said, we'll have to see the facts of each case and what the quantum is, but there will be no indexation benefit. That concept itself is gone.
Yeah. Another question for you, Ketan sir. With respect to holding period, would you suggest that gold ETFs be considered a better opportunity compared to gold fund of funds? And also, would the same thing apply to foreign equity ETFs like an S&P 500 ETF?
See, I think Saurabh and Shravan are more equipped to answer that. But because, see, one is the opportunity, the valuation, where the markets are moving, and the tax. So from a tax perspective, anything which is listed. So, for example, if a fund of funds which is investing in US equity is listed in India, then it will fall under the listed regime, etc. We've gone into that. But I think the larger question maybe Saurabh can answer.
Yes, Ketan bhai, thanks a lot. I guess the way the current memorandum is written and the way the current bill reads, it seems that every listed instrument will get the benefit of qualifying for long term at the end of 12 months. Whereas the mutual fund units, which is in the residual category, which is neither debt nor equity, will get the benefit of qualifying for long term at the end of 24 months. So right now, the way the English read, it seems that ETF will make more sense than a FOF,
Right.
especially if the holding period or the investment horizon of the investment is less than 2 years. Some of these allocations are not made generally from a 2-year perspective. They are made from a little longer investment horizon. As soon as you increase the investment horizon beyond 2 years, the considerations around the liquidity, the transaction cost, the availability will start preceding because tax becomes neutral after 2 years. However, the finance bill, when it is finally approved, if there is any further English which gets added between now and the final date of approval, we will have to read that English. And if there is any more clarification given by the government, then we will have to interpret that. So the stand may change from what it is currently, but this is what the reading is. So ETF will get considered as listed securities.
Got it. Is the new tax effective from July 23rd or effective from April 1st, I suppose, 2025? Shravan, you want to?
So tax on what?
The new tax regime. So I suppose it means the new tax of 12.5% and 2 years holding.
No, that's from yesterday, right?
Yeah, except in case of other kind of mutual funds.
Yeah.
But
So can you highlight why have put the date?
I don't know.
Sorry,
I
25.
mean, the
25.
other mutual funds part, I don't know whether they want for those kind of complex kind of fund, they want to give more time. I really don't know because see, first of all, normally the budget comes before the financial year. So because this was because of the election year, it has come, the date it has come. So rest of it is 23rd July. But actually, if you honestly ask me, all of this should have been made applicable next year. Just makes it simpler. Because you now, and remember, I don't want to go into this, but you have these absurd, issues of administration, like 26 AF, how it will reflect, how you put it in the return next year. By the time you file your return, you've forgotten all these things. It's going to become a nightmare from an administration standpoint. But Shravan, I don't know why they've done it half year and half year.
Okay. There's one question.
Resident, what was that?
Yeah. Can you hear me? Am I audible?
Yeah, I can hear you.
Yeah. So the question is, what has been done on simplification of ODI? Can we take resident individuals into SAFE?
See, first of all, investment through LRS schemes, but the resident may have a company which can make ODI investment. ODI can be made only for operating businesses. In fact, unfortunately, the August 22
investments as resident individuals into
RBI
SAFE.
regime talks of rights and bonus for portfolio, but there is no reference to original shares. So the original impression was that you can use the company to make portfolio investments, but that does not seem to be the regime, and there is no clarity. Now, when we clarify that, what happens, I don't know, because although it's been cleared as a result of August 22, and when you deal with the is not working.
So thanks very much for that. So I will take up from here. Saurabh, one question is, what is the impact of these taxes on venture debt funds and rental?
If you don't mind, I will
Yes, sir.
need to log off because I have another comment. I hope
Yeah,
that is
Mr.
okay, and I'm sorry for that, and thank you for this
Mr. Ketan,
opportunity.
thank you
and
very much. Thank you very much, sir. Thank you. Thank you. Looks like there is a problem with IT. We'll just wait for a minute for people to come back. Yeah, Saurabh, question is for you.
Yeah, please.
Yeah. So what is the impact on venture debt funds, right, and special opportunities fund with the new tax regime?
So venture debt funds and special opportunities funds are AIF category 2. The income that is earned by them is a pass-through status and it gets passed into the hands of the investor. The nature of the income does not change. Venture debt fund gives you majority of the income by way of interest, and same is the case with some of these the second category of the funds. I guess performing credit and special situations fund you called out, now, Shravan?
Yeah, that's right.
So both these categories, a decent portion of the income comes out as interest income, and that interest income continues to remain taxable in the hands of the recipient as MMR, as at the slab at which you are. Whatever portion of the income comes out from these funds as capital gains on the distributions, the distribution is the nature of capital gains being made from the underlying investments. Those capital gains will now get the benefit of getting qualified as long term if the gains is arising after 2 years of holding period, and the 12.5% benefit will be extended even in these capital gains.
Got it. Thank you. Dhaval, this question is for you.
Sorry, Shravan, yeah.
Sure. One last question and I can take it up.
Yeah.
Sure. Sure, Shravan.
Yeah. So what is the taxation change that is needed to be clarified as OFS at IPO?
So there is one specific amendment. So one is the holding period and the beneficial rate that is available for shares being sold as part of the year. So while the period of holding will continue to be 24 months, the beneficial rate of 20% and 12.5% will be available. Further, there is also an amendment to take
Isha, audio.
There's a cost. Hope this answers,
Yeah,
Shravan.
thanks, Dhaval. Isha, audio.
Yeah. Maybe Saurabh can answer this. Now that the indexation benefit is gone, do performing credit funds make more sense compared to credit risk or long duration debt mutual funds?
Sorry, Trisha, you will have to repeat that.
Yeah, Saurabh, can you hear me now?
Yeah, much better.
Yeah. Now that the indexation benefit is gone, does performing credit funds make more sense compared to credit risk or long duration debt mutual funds?
Actually, the tax change, thanks a lot, Trisha. Actually, this tax change of indexation and the long-term capital gains benefit and mutual fund debt scenario had got reversed last year itself with the last year's budget. So the arbitrage that the mutual funds were enjoying and the post-tax returns that they were able to give, the elevated post-tax return, that has disappeared since last year itself. And that's the precise reason why we have seen many more launches in the performing credit and the structured credit space for the last 12 months to 15 months. So yes, today, debt mutual fund is on the same platter as a direct debt holding. Interest gets taxed as interest income MMR. There is no benefit of it getting converted into capital gains as was happening through the debt mutual fund platform. So this arbitrage has got taken out 15 months back. It is not this yesterday's development. And they will continue to remain more attractive now.
Yeah. So Saurabh, you can maybe answer this one also. Gold ETF returns for the past few days have been negative. How does the change in BCD impact these ETF movements?
So what happens is the price that we see of gold in India includes the impact of the customs duty, which was at 15% before we got into this, before yesterday. And now that it has been brought down to 6%, that 9% correction in the price of the INR price of the gold will immediately get corrected to the extent of that 9% correction in the duty. So the last few days, even if dollar gold value, if you see, it would have been in that same handle of 2380 to 2390 dollars per ounce. But in INR terms, you will now be seeing anywhere between 7 to 8% negative return, which is the one-time correction impact of this BCD, which has taken place. From now, it will again mirror the dollar gold movement plus the dollar INR movement.
What are the possible impacts that you could see on REITs and InvITs as an asset class due to the change in the holding period? Shravan, if you want to take this one.
No, I think it's very positive. I think we should step back and listen to what the finance minister is saying, right? Finance minister is saying that, look, I don't want you to put money in low yielding asset. Okay, I want you to put money in high yielding asset. right? And I will tax you more, but you can earn more. That's what the message is being very clearly spelled out. They would want to increase. So on one side, they have decrease the effectiveness of indexation, for the real estate. But on the other side, they want to promote REITs as a financial instrument. And they've been talking about, SEBI has been talking about it, right? So by bringing down the taxation from 3 years to 12 months, and they've clearly spelled it out, in the wordings, this actually is very, very, very positive. Not that people want to invest for 3-year, 4-year time frame, but it just gives a comfortable flexibility that after 12 months, if you want to redeem, we can still do that. So instead of paying a higher tax, you might pay a lower tax on the REITs and InvITs. So I see this as a potential opportunity to invest. There are many, many more REITs that would come from the unlisted space into the listed space. This is a positive thrust that is much required for this particular asset class. In the last 3-4 years, there have been quite a few to and fro that happened in terms of some of the issues that they have got. And I think now the tailwind is very clear. And this looks like a good opportunity to capture this particular asset class.
Okay. Anirudh, I think maybe you can answer this question. Was there a need to increase the LTCG rate for equity?
Was there a need? Well, it's a tricky question. I would tend to say that 10% is something I think most people in the country who are salaried would be, or even from business side would be thinking that it's a bit low. They'll be paying a bit more, particularly on the Yojana side. And I think the government wants to just make sure that there is a little bit of I won't say curbing the enthusiasm, but just saying that, look, if things are doing very hunky-dory, maybe you can spare a little bit more and give it to the coffers. So was there a need to do that? I think there was a need probably more on the short-term gain, because I think there is a thought process between the regulators and the government that you don't want excess speculation and exuberance in the market where people who probably have not seen a cycle are putting money, and in case the cycle turns, then it could be a pretty bad loss for them. As a deterrent type, I suppose, and to unbridled proportion of investment of your savings into equities, I think this was more of a token increase on the long-term side. I think the short term was pretty much expected that it was going to go up. But yeah, as I mentioned, from worries to no expectation whatsoever of increase in LTCG to a 2.5%, excluding the surcharges, I think people will take it.
Another question that I think you might be able to answer is, there's not a big change in the taxation for arbitrage funds. Is that a negative for the banks?
But I don't think so. I think the more query was there going to be anything in the budget which specifically leads to people coming back to putting deposits. For example, I would tend to have said that, look, they've mentioned that capital gains up to 1.25 lakhs is going to be exempted from tax. Now, there is also a provision where you said that in case you get about 10,000 rupees from your bank deposits, that's exempt from tax. If that particular 10,000 rupees, let's say, would have been made to about 15,000 or 20,000 rupees, that would have probably given a bit of a fillip as far as deposits are concerned on the CASA side or so. I think that was a bigger query, that whether this kind of a push could have been come by the government. But I'm not very sure whether this arbitrage change will, or lack of change, would that going to be impact as far as equity investments are concerned.
In fact, if I may add, Trisha, here, will it be an impact? There will be some marginal impact, is what I would believe, Anirudh and the guys. But take it in the context that the CASA deposits are in the handle of 215 lakh crores or 215 trillion INR. And the arbitrage industry is hardly a few lakh crores. So the context is very different. I guess the bigger victory for the CASA guys or the banks was when the entire debt mutual fund capital gains taxation was taken away last year. That was a bigger victory for them. Arbitrage is a very small piece in the entire jigsaw puzzle. So I guess by not taking out, yes, the arbitrage still remains, and then the intelligent guys will still continue to put into an arbitrage fund to get a 6% post-tax kind of an experience as against a CASA deposit. But it's not going to move the cheese for majority of the people at all. nation's level.
Great, thank you. I'll just take last two questions, I think. Is buyback still a lucrative option for private company promoters? Dhaval, you want to answer this one?
So from a tax perspective, the buyback is now at par with dividends. The only catch versus buyback is that is upfronting of and to that extent a capital loss is available. So effectively, but if you look at it from a valuation perspective, probably it shoots up the EPS because the number of shares will go down. So it may impact valuation. Shravan, maybe you can take up the valuation aspect which results out of the buyback that is done.
No, I think there is echo. Can you hear me? Okay, so I think when you look at from the promoters front, I think if the cost of acquisition has been low, and they do a buyback, and that's usually the case that they do. I think the net outgo from a tax perspective, I think still remains the same. It's only when fresh investors come to take advantage of it, that's where the loss of capital gains to be set off against another capital gains is not matching up. So I think there is a lucrativeness available for private company promoters for sure. In terms of listed, you need to look at really whether it's a long-term investors doing it or it is the short-term investors coming in for the buyback opportunities. Saurabh, I think we discussed this earlier. You want to add something to it?
Yeah, I guess aptly worded. So guys, if I have to simply give us as an example, two examples. One, buyback was being taken as a route by some of these listed companies, especially the tech companies and the IT companies, to keep on distributing dividend at a lower effective tax rate for the end investor. And you had every time an announcement will happen, people will go and buy the shares of that listed company and then tender the shares in the buyback window and get the benefit. I guess that opportunity is completely squashed under this current regime because the entire amount that you receive under buyback gets taxed at the maximum marginal rate. So unless and until you are in the lowest tax slab, you will not go for this opportunity anymore. And the second example is for UHNIs, HNIs, family offices who are also having their own private businesses or who had also created their own private limited companies and who wanted to pull out cash from their own company. In that scenario, I guess now the arbitrage has been taken away. So whether you give it out as dividend or whether you pull it out as buyback, it is more or less the same piece. In case anyone has more finer points to discuss, we are very happy to engage with them separately.
Thank you. I'll take the last question. Anirudh, I think this one could be for you. Will the F&O volume come down due to the STT change?
At the margin, you can say yes, but I don't think as a concept, you probably will stop trading just because of the increase in the STT. I think the idea is that, yes, there is at the margin, you can say there's about a 60% increase in what, some of the STTs are in terms of the F&O side or so, pretty high. But, and the whole point, once again, is to be a bit of deterrent as far as exuberance is concerned. I don't think the idea is to derail the F&O volumes. I think, so my sense is that, yes, exuberance a little bit, yes, that would be down, but will it derail? I don't think so.
Thank you. Thank you very much. Saurabh, I'll hand it over to you for the closing remarks, and then we can close the webinar.
Thanks a lot. Thanks a lot, Trisha. Guys, I guess as Trisha and Shravan had started, it was one of the most coveted events that we were waiting for, especially after the budget. Given the election results, there was a lot of fear that this budget could have gone down a very populist way. But I guess the government has continued with the entire messaging and the practice that they had shown in the last 10 years. They continue to remain very fiscally prudent. which can be a very strong hint to some of the international rating agencies towards improving the sovereign rating of the country. I guess the second big thing is employment. I guess employment did become a very big agenda point for the elections. And I guess government has really announced good policies. The three policies that they have announced towards employment, they are really very good on paper. If it gets implemented, it will be a very pleasant change. And the good piece again in the employment policies that the government has rolled out for everyone to notice the fact that they have linked it to EPFO. So it's not a free cash dole out as a DBT transfer, and you can just show a fictitious employment and take the cash and walk away as an employee or an employer. This is now linked to EPFO. So you will have to demonstrate that 10 to 12% as employer contribution and employee contribution, nearly 20 to 24% of your salary is getting credited into EPFO month after month. So it's a very thoughtful step that the government has taken towards the employment. Many more steps have been taken by the government towards social justice and urban poor and the backward states of especially from the coalition partners of Bihar and Andhra. So I guess all in all, I guess it's a very good balancing act that the government has done. More importantly, what we need to understand is we may say that there was no such wow factor in the budget and there was no such wow announcement in the budget. But actually, when we are chugging along for the last 10 years at a 6 to 7% real growth and 10 to 12% nominal growth, I don't think the government there's any need for the government to do anything wow. They just need to continue to do what is being accepted by the society, by the country at large. They just need to continue to let that work go on. They don't need to act as a instigator for accelerating it or deaccelerating it. Let it go on. I guess a 10 to 12% nominal growth is a fabulous growth for the country. And if we continue to compound at this rate for the next 10 to 15 years, we will be having our lifetime opportunity for making wealth through investments. The last piece I will say is, I guess, while indexation is getting played out a lot more in the minds of the people, two things I will submit there is, as Shravan correctly concluded and presented in the call, for a 3-year indexation horizon, the actual tip over point is 12.5%. So if your asset is making you return in excess of 12.5%, then you're better off with the new tax regime than the earlier indexation regime. And this 12.5% tip over point will keep on falling with every increase in the holding period. So in a 5-year period, instead of a 12.5%, you will find that even a 12% asset, if your asset had given you 12% return, you would have been in a better off scenario in the new regime. If it goes up to 10-year holding, then the return tip over point will come in the handle of 10 quarter, 10 half. So this number keeps on falling as the investment horizon keeps increasing. So, and I don't think so any of us are investing into any of these assets, which is private equity, angel, and any of these things with an expectation of making lesser return than even a listed equity. Our expectations are in the late teens or the early 20s. So I guess it will be a very good welcome change. And more importantly, I guess the arbitrage that the government had created or income tax department had created between the listed equity shares and all the other asset classes. And that's why you were seeing a TINA effect of all the assets and liquidity flowing into the listed equity asset class. I guess there is one lesser reason for that TINA effect to keep on crowding the listed equity space. If I can say, it's one of those golden days to be written in the history of Indian budget or Indian taxation regime, where all asset classes from a long-term perspective have been brought at the same plinth. After 24 months, you all are going to get taxed at 12.5%. That's a very big thing. I guess we will see the benefits of it in the times to come. I guess we will digest this in the coming time and we'll appreciate it. Look at the long-term capital gains tax regime of any of these Western economies and developed economies, and you will be surprised that no one has anything less than 20% in LTCG. Okay, so a 12.5% same level playing field for all asset classes will result into lot many more opportunities getting opened up and lot many more opportunities getting evaluated by us in the due course of time. So I guess it's a very well thought out budget by the government. tax changes takes precedence in this budget because there have been a lot of them. As Shravan had called out, there are a lot many more things if you are just listening to it for the first time, and there is a lot many more data points and information that would have got thrown at you in the last 1.5 hours. But please take time, read through it, digest it, and in case you feel at any place a need to again have a call with any of us, we are always present at the Avendus Wealth family. Reach out to your wealth manager and we will get connected.